we do know that once they stop flinging poo at each other, they're going to make a deal. And after that deal is cut, over $1 trillion in Treasury bills are going to flood the market all at the same time.
You're it. Quincy's! Anti-quincy's. You're it, quincy's. No anti-quincy's, no startsies. You can't do that. Can't do. Cannot. Stamped it. Can't do double stamped it, no erases. You guys! Enough!
If you're looking for physical gold or silver, go to MilesFranklin.com or call 855-GAME-END and tell them that the Endgame investor referred you. This week's special is 10-ounce silver Ital Preziosi bars, only $3.49 over spot while supplies last. These are the lowest prices you will find on the interwebs for silver bullion. Hey guys, Raf here from the Endgame Investor, and today we're going to take a little trip down memory lane to September 17th, 2019. It was a simpler world. Putting the world under house arrest for a cold didn't exist, and people still actively pretended that free speech was important. It was a mere month after Jeffrey Epstein killed himself. It was a time when, like today, the Fed was shrinking its balance sheet off of 2011-2012 quantitative easing number 3, and they came up against a little bit of a problem in the repo markets. Just like today, when the Fed is shrinking its balance sheet from QE lockdown, and they're coming up against a bit of a problem that the regional banks appear to be going bankrupt because all the treasuries they were forced to buy as all this money was pouring into the economy are now much lower in value because the Fed is raising interest rates. Who would have thought that this could have been possible? It was a time when a deluge of treasuries in the tens of billions of dollars, yeah, it was that small of a deluge by today's standards, was enough to upset the repo markets and push the upper rate of repurchase agreements up to 10% overnight interest rates. The Fed immediately stopped shrinking its balance sheet, went back to QE, and the rest, as we know, is history. So let's take that trip down memory lane, and we'll see what the parallels are to today. Here's an article from the Financial Times dated September 18th, 2019, title, Fed Sees Huge Demand for Cash After Money Market Jolt. And just so we see some historical context into what was happening back then, we have here this blue line of the secured overnight financing rate. This is the average of repo rates for that day. And it looks like the average on September 16, 2019 was about 5.25%, way outside the bounds of the Fed's interest rate targets for that day. What was happening? This is what was happening, people. Financial Times, September 18th, 2019. The Federal Reserve Bank of New York will inject a further $75 billion into the U.S. financial system on Thursday morning in its third attempt to steady one of the world's most important money markets. What was going on then? Perfect storm. It was perfect. Joseph Abate, or Abate, or something, a managing director focusing on money markets at Barclays Capital, another primary dealer, said that a perfect storm of temporary pressures had struck the crucial portion of the financial system in recent days. Analysts specifically pointed to corporations pulling billions of dollars out of money market funds, which are typically major providers of cash and repo transactions, ahead of tax deadlines as a key component of the shock. It had been exacerbated, they said, by a flood of treasuries hitting the market, something that sharpened dealers' demand for cash via repo transactions. So you had three things. You had a shrinking balance sheet, tax day, and a flood of treasuries. Let's go to the next article. Fed injects liquidity into markets as key rate busts through cap. Bust a cap. Isn't that like a saying by like gangs? Bust a cap?
Bust a cap in his ass.
Good gracious, I should bust a cap in your ass.
September 18th, 2019. The moves of the Fed's injection of $75 billion in cash we see up here. The moves underscored just how deep the structural problems in U.S. money markets have become. Namely, there is often not enough cash on hand at major Wall Street firms to meet the funding demands of a market trying to absorb record Treasury bond sales needed to cover U.S. budget deficits. The solution, according to longtime observers, would be for the Fed to continue to inject cash on a regular basis. And you know what we had just a few months later? The lockdown printing. What caused this repocalypse of September 2019? A couple of catalysts caused the liquidity squeeze in this esoteric yet vital corner of finance known as repurchase agreements. There was a big swath of new Treasury debt that settled into the marketplace, adding to dealer balance sheet holdings, just as cash was sucked out by quarterly tax payments companies needed to send to the government. If left unchecked, the escalation in rates could do damage to the broader economy by hiking borrowing costs for companies and consumers. What did the Wall Street Journal say? The spike in overnight repo rates, this is also September 2019, the spike in overnight repo rates was caused by a string of coincidental events, including corporate tax payments and Treasury sales, according to analysts and investors. But those events had only such a startling effect because banks were already operating close to the minimum level of reserves that they want to hold. And finally, we have Reuters. Market participants said a confluence of events caused the cash crunch. Corporations withdrew funds from money market accounts to cover their tax bills. On the same day, banks and investors used idle dollars to absorb $78 billion in U.S. Treasury notes. $78 billion. That's a lot of money. 78 billion. Well, how much do we got coming now? Well, we do have this little problem called the debt ceiling, and we have these stupid negotiations going on where all these monkeys are poking each other and throwing poo at each other in Congress.
Mock, yeah, ing, yeah, bird, yeah, 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 mockingbird, don't everybody have you heard?
And whatever they're talking about doesn't make a difference, but we do know that once they stop flinging poo at each other, they're going to make a deal. And after that deal is cut, over $1 trillion in Treasury bills are going to flood the market all at the same time. How do we know this? Let's fast forward to the present. We're just a few days ago. Wall Street fears $1 trillion aftershock from debt deal. May 18th, 2023. This is only about 5 days ago. Quoting a guy named Ari Bergman. What the market veteran is getting at, Ari Bergman says, is that Treasury will need to scramble to replenish its dwindling cash buffer to maintain its ability to pay its obligations through a deluge of Treasury bill sales, estimated at well over $1 trillion by the end of the third quarter. The supply burst would quickly drain liquidity from the banking sector, raise short-term funding rates, and tighten the screws on the U.S. economy just as it's on the cusp of recession. Here's what Bergman says. My bigger concern is that when the debt limit gets resolved, and I think it will, you're going to have a very, very deep and sudden drain of liquidity, said Bergman.
Commence Operation Vacuum Suck.
Founder of New York-based Penso Advisors. This is not something that's very obvious, but it's something that's very real. And we've seen before that such a drop in liquidity really does negatively affect risk markets such as equities and credit, such as it did in September 2019 when you had a confluence of a Fed shrinking its balance sheet and tax payments and Treasury sales all on the same day. So what do we have now? We have the Fed still shrinking its balance sheet. See here. See this curve up? This is QE3 from way back when we were all young and impressionable. And then the Fed kept its balance sheet steady here, and then it started shrinking in 2018, going down, 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 selling off or allowing them to mature treasuries and mortgage-backed securities, etc. And going down, 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 down. And we have September 2019, and bam!
Bam! Oh yeah, bam it again, Elzai. Knock it up another notch.
We have the repo crisis, and we start increasing the balance sheet again, and then
Bam!
we have lockdown money printing, and then we have all this other stuff, and it goes up and up and up and up and up and up, and we peak out, and then we start raising rates again and shrinking the balance sheet, and we have this, oh, bam, bam. We have a banking crisis, and it goes back up again. Now it's really shrinking again and again and again, and we're about to deluge about $1 trillion of Treasury bills onto the market while this balance sheet shrinking still goes on. Plus, we have tax day for corporations on June 15th. But the Treasury is not going to be able to get there unless they raise the debt ceiling in time, because I kajiggered a chart, and I'll show it to you now. It's my own kajiggering. They used to call me the kajiggerer in high school. That's how I was known. Really. I'm not joking. Said to me, Ravi, you're like the best kajiggerer in the world. This I got from the MSPD. That stands for Monthly Stupidity of Public Delusion. Or like monthly statement of public debt, but what is the difference anymore? So I went through the entire thing and I looked at the coupon payment dates for notes and bonds outstanding, and I found out that on May 31st, the total that is owed in interest is going to be this interest rate multiplied by this outstanding in that particular bond series, all due on May 31st, comes to $15.88 billion. And how much does the Treasury have left? About $57 billion. And on May 31st, they're going to have to pay $15 billion of that, or $16 billion of that. They don't have that much money left, about $40 billion to spend between now and May 31st if they want to cover that interest. They might not be able to, so the poo flingers have to figure something out quick, or we're going to get into default. Then the entire pyramid could collapse. But in the meantime, even if they find a deal and they're able to agree on trillions of dollars more in treasuries flooding the market all at the same time, that could lead to some problems in the monetary sewers where all the crap sewage is being blocked by a whole bunch of sewage. It's not pretty.
Well, you see, boys, the sewer is a fragile ecosystem. These new folks in town eat nothing but couscous, tofu, and raw vegetables, and it's destroying my environment.
Anyway, the point is, deal or no deal, the banking system is toast. This is Ralphie with the Endgame Investor. If you appreciated this video, then sign up for a 2-week free trial of the Endgame Investor, or become my patron on Patreon, where I give a biblical perspective on monetary sewage. You bet you never heard that one before.
Hey, want to hear the most annoying sound in the world?